A little bit of housekeeping before we get started. This webinar is being recorded, and we'll email it out to you afterwards. So if there's something you missed or if you wanted to re-listen for any reason, it will be sent to you via email. While Erin is presenting, if you could mute yourself so there's no background noises, dogs barking, all that kind of fun stuff. But if you do have a question, you can unmute yourself later for that. If you're having trouble with the audio quality, I find it is best if you call in. Under the audio tab, there is an option for either computer audio or phone call. If you click phone call, it'll give you some dial-in instructions. And like I said, if you have questions, we want to make sure that those get answered. You have two options. You can either raise your hand, which is this blue hand symbol, and then you unmute yourself and you can just ask it. Or if you'd like, you can type it into the chat box and we'll answer them that way. So a little bit about the Washington Center for Women in Business and why we're doing the Let's Talk Business series. We are an SBA, a Small Business Administration Women's Business Center, and our goal is to help women in business reach their next goals. So whether they're an existing business and they want to hire employees or grow their profits, or they're somebody with an idea and they want to launch that business and be successful in it, we're here to help kind of fill whatever gaps you might have as a business owner. We do a lot of workshops, whether it's online like this one or in person around the States, and then a lot of one-on-one coaching. So you'll get a little bit of general information today, but if you wanted to talk one-on-one about this topic or anything else that you might be struggling with in your business, then you can talk one-on-one with our business coach, Christine Buckley, to get you to your next goal. It is free to work with us for the first time. After that, it's $25 for a 50-minute session. However, if that $25 is out of the question for you right now, we do have scholarships available. We never want that to be a barrier to your business success. So with that, I will transfer the presentation here over to you, Erin, and let you take the wheel.
Okay, great. Tracy, I'll just confirm once more. Can you see my screen now?
Yes.
Okay, excellent. And thank you very much. Welcome, everybody. I'm very excited to be here. This is my first time participating in a webinar working with Tracy, so I appreciate the opportunity. Hopefully today's topic won't be too dry. My goal is to try to take what is typically a rather less than exciting topic and hopefully give you a different perspective on it. I would like to thank Tracy and the Women's Center for Women in Business and all of you for being on the call today. It's a fun way to spend my lunch break, so thank you. As Tracy mentioned, the muting does help, but if you do have questions, I very much like this to be more of a dialogue, so I'll do my best to check out the chat section, and so if you have a question, feel free to drop it in there. Tracy, I think, is also going to help me make sure that we don't shoot past something that may be addressed in a relevant manner. At the same time, don't hesitate to unmute if you want to ask a question, because again, I much prefer to have a dialogue than a one-way presentation. Just to give you a little bit about me, I actually don't like talking about myself very much, but I suppose it adds context since I may not have met many of you. My name is Aaron Rodriguez. I am the Managing Director of ACR Business Consulting. It is my own consulting firm. I'm based here in Olympia, Washington. I do most of my work in the South Sound area. I do have some clients up in Tacoma and Seattle, but for the most part, most of my clients are here locally. I enjoy the community. I live here in Olympia, and I'm actively involved where I can be. So I'm a local resource and always willing and excited to talk about business with anybody who's trying to tackle big problems. So don't hesitate to keep me in your Rolodex as a resource going forward. I am a classically trained banker. That is the term that I've now come up with because to me, classically trained has a level of sophistication to it that sounds a little bit better than saying I was a banker. But in all reality, my background is in finance and business management. I did kind of learn the trade as a banker. It was not the most exciting work for me. While it was fun to assist clients, at the end of the day, it was very static, and I very much enjoy rolling up my sleeves, diving in and seeing what can be done, especially when there are good ideas and good people trying to bring things to life. To that point, after I left working for a bank, I kind of pieced together over a 13-year career a lot of hands-on experience essentially running various businesses. I was the general manager of a successful restaurant chain. When I took the reins, the store was number 5 in the company of just under 100. And in about 22 months, we moved that store to the number 2 store in sales. From there, I moved on to actually helping a food cooperative get its feet under it. It had been in business for about 3 years and was doing about $250,000 in revenue. And over the course of about 15 months, we were able to double the membership and almost increase sales by 3-fold. From there, I actually took a step back and ran a small farming business, family farming business. We worked with local markets around the area. That was actually an exciting endeavor I learned a lot about. And then I moved on to serve as an interim executive director of an independent school. When I was hired by them, they were actually essentially a homeschool program, and we moved them over 3 years from a homeschool program to having 64 students enrolled, getting into the second stage of accreditation of a 4-stage process, and was acknowledged by the Nisqually Valley News as a winner of a best of back in 2015. And then lastly, I just moved on from that and decided that rather than kind of diving in and spending a lot of time on specific projects, I enjoyed helping a lot of people at the same time. So I started my own consulting firm, and I've been doing that really since 2015. And I tell you this not to toot my own horn, because as I said, I don't enjoy talking about myself, but there's the theme of wins I want to point out, because it isn't that I was an expert in those fields by any stretch of the imagination, but today's topic, the profit and loss statement, and in a broader sense, the financials, was the consistent theme that I used to achieve success across various industries. So that's what I hope we can talk about today and explore together how the profit and loss statement can help you specifically in the business that you're in. Lastly, I'm a numbers nerd and I'm a fan of puzzles. Just to give you an idea, so you don't think that I'm kind of business 100% of the time. I am numbers 100% of the time. This past weekend, I'd like to share this story with you guys. I was helping my daughter make some pumpkin muffins, and the recipe called for 2 cups of sugar, which didn't seem like a lot until I started wondering in my mind how that translated to grams, because grams of sugar to me has a better connotation from sodas, various food products. So long story short, the numbers geek in me figured out the conversion between grams and cups. Turns out, a little factoid for you, 2 cups of sugar is actually 680 grams of sugar. There was 12 muffins in that batch, so each muffin we made had 57 grams of sugar, which is a tremendous amount of sugar. So just a practical, hopefully a practical portrayal of my inability to turn off my numbers brain, but also kind of showing the practical application of looking at numbers and understanding their correlation even outside of your day-to-day business. In a nutshell, today, basically the headline would be, if we had one kind of algebraic formula that we were going to be talking about, it would be the P&L equals your objective business story. And as I mentioned before, the businesses that I was working on, that we had a lot of success in, and even the organizations and businesses that I work with now, the very first thing I try to get my hands on as soon as I can is an organization's P&L statement. And as we spend a little time together today, we'll dive in and I'll be able to point out to you why that's so critical. There are really two themes or two narratives that just about any business has going for them. And the first one is the story that you as the business owner or as the individuals that are part of the leadership team or executive team, it's the story that you tell. And it's an honest story. But the reality is that it has to very much be a embellished narrative. I always joke with business owners that, I sit down and I ask you a particular set of questions, and I know full well that that story is going to be essentially 2 parts marketing, 1 part unbridled optimism, and maybe 1 part reality. But that's the way it has to be. You're constantly marketing your business. You've got to tell an energetic story. You've got to get customers excited. You've got to get donors engaged. Whatever your line of business is, if you said, well, I don't know if our rent expense is in line with industry projections, nobody gets excited about that. But the truth is that you've got the opportunity and responsibility to really be able to understand both narratives. The marketing narrative that you tell, the one that you tell front-facing to your customers, and then the one that your P&L is telling you. And so essentially, when I meet with any new prospect or take on a new client, I'm asking the question to the owner, and then essentially turning right around and asking the exact same questions to the P&L. And the thing I love about the P&L is that it doesn't lie. It pretty much tells it the way that it is. And I can get a very clear sense from how a business is doing based on the story that's being told by the owner and the story that's been told by the P&L. And again, I don't expect them to necessarily overlap 100%. They shouldn't. But key areas should absolutely corroborate with one another. So this is basically what I want us to spend some time talking about today, is what is the objective business story that a P&L is trying to tell you, regardless of industry. Any questions on that at this time?
None have come through.
All right. So before we get into this, one of the things that I want to do is actually look at a P&L. I've got, it's just a dummy mock-up, but it essentially allows us to make sure that we're talking on the same wavelength. At the same time, those of you that are on the call, if you do have your own P&L, don't hesitate to look at it, reference it. If questions come up as we're talking on this general one, ask them. This is a tremendous opportunity to ask any question. There's no bad questions, even down to what does this mean? How can I find out more information about this? I often find that most people actually have a sincere curiosity in understanding the financials of their business, but oftentimes they face hesitation to speak up because they're afraid of asking a dumb question. It really isn't a dumb question in my mind, even if the question is, where do I start? Because the minute that you ask those questions, you start to care. And then your brain will inevitably be able to find the answers that it needs. And as you explore more and more, you find professional partners, the resources materialize, and next thing you know, you've built up a solid vocabulary and a solid understanding of your financial statements. So I'm going to pull up a P&L here, so give me 1 second. And Tracy, I'll just use you. Confirm that. Can you see this spreadsheet that I opened up?
Yes, and we did get one question from Thomasina. What is COGS?
Oh, great. So COGS stands for, and I was going to cover this, you actually see it broken out here in the spreadsheet. COGS is cost of goods sold. Cost of goods sold is typically related to manufacturing firms, grocery stores, restaurants, anything that requires materials to produce a product. So organizations that have a service won't have a cost of goods. My consulting firm, for example, does not have a cost of goods. My service is essentially sourced right away. If I sell apples at a food co-op, my cost of goods is the cost associated with buying those apples and then being able to turn around and sell them, hopefully for more than I paid for them. Does that address your question?
No response, but no more questions, so.
No worries.
She said yes, thank you.
Okay, great. Okay, so this is just a very basic P&L. And again, there might be some aspects of this that aren't relevant for your business. There may be some things on here that you haven't considered including in your business expenses. So hopefully it's useful for you. If this is a tool that you would like at the end, of the presentation, don't hesitate to reach out to Tracy or me directly. More than happy to send this to you. But basically, you're going to get kind of a common theme of me trying to make this as fun as possible. Rather than calling this a workbook, to me this is a playbook. P&L is essentially a playground where once you've put in and installed the equipment, you can get in there and do whatever you want. One of my favorite things to do is watch my daughter on the playground sort of hop around from the swings to the slide to the monkey bars, make her way back. In her mind, nothing is off limits. And that's really what I try to create for my clients, is a tool that they can just get in and simulate and explore, and they can't break anything. But it's very key to understand what are the aspects that build up a P&L. So as we go through this, like Thomasina's question, if you see a line item, you're not sure what that is, don't hesitate to ping me, dive into that a little bit deeper. But effectively, I'm going to talk at a very high level. So if there's more specific questions, don't hesitate to reach out. In the most simplistic sense, though, P&L is effectively your sales, if applicable, the costs to generate those sales, which is a net revenue. Again, as a service, if you don't have any cost of goods, your sales typically represents your gross revenue. If you do have costs of goods sold, you absolutely need to incorporate that before determining what you have available to cover your operating expenses. Operating expenses basically encapsulate everything that is required for you to operate your business. Things such as accounting costs, advertising and marketing, business licenses, permits, if you have to utilize a vehicle, cell phone, cleaning supplies, continuing ed for you or team members, copying, printing. You can see this again is very much an exhaustive list in a general sense. Certain businesses might have specific industry-specific or business-specific line items, but the goal of this tool is just to capture as much of the general things that most businesses have to deal with in operating. So you have your sales, cost of goods if applicable, giving you your gross revenue. Then you work through your expenses, and I'll talk a bit about why these are highlighted, and we'll also talk about what this is actually telling us. But after that, you've got your total expenses. And then your gross revenue minus total expenses tells you how much you have to work with at the end of the day. These are all placeholder numbers, but they'll allow us to explore together how this business is operating, look at some peculiarities that might yield a business owner, might yield more questions for a business owner or a third-party professional such as myself, or a banker, or an accountant, CPA, or even a business coach at the EDC to dive in a little bit deeper. So one of the things that I know in most organizations that I meet with, when they first start out, they've got a P&L or they're not even sure where to start. Too often they will effectively operate off of the real dollar value. And this is good to sort of orienting yourself to your size and aligning yourself with your personal narrative. For example, if you sat down with a customer or a vendor and you said, I want to be a business that's doing $20,000 a month in gross sales, and your P&L shows that you're currently doing $10,000 a month. Effectively, what you're saying is that you want to double the size of your business. And if I am somebody who speaks the language of a P&L, I'm going to make a note that you said, I want to grow my business to $20,000. Now notice you didn't tell me that you wanted to double your business. So I'm taking notes and I'm saying, okay, by when? You say in 3 years I'd like to grow to $20,000 in sales. And then I say, okay, fantastic. Now let me talk to your P&L. And you get me your P&L. And just because I have 20 in here, let's change the example to say you want to go to $40,000 in sales. So I get the opportunity to look at your P&L, and I see that you're currently at $20,000 in sales, and in 3 years you told me you want to get to $40,000 in sales. So now the P&L is telling me where you currently are, and aligned with your narrative, the P&L is telling me you want to double your sales in 3 years. Without context, that sounds fantastic. But if in talking to you, you said, I've been in business for 7 years and I'm doing $20,000 in revenue. And now I know in 3 years you want to double that revenue, but you want to do it in half the time. Doesn't mean it can't be done. Doesn't even mean it's an untrue statement being told by you. But your P&L is actually trying to help you. And it's saying, we want to double in 2 years, or we want to double sales, but we want to do it half as fast. So somebody like myself, or even you as a business owner, because of the P&L's ability to tell you kind of an extended narrative there, it's allowing you to ask more intelligent questions of yourself, or questions that you'd expect a third-party professional to start asking you. For example, what do you believe is going to allow you to grow twice as fast in half the time? You may say, we've got access to some government contracting that wasn't available to us for the first 7 years. You might say, I don't know, but I'd actually like to look at structuring my business to take on an equity partner to allow me to have additional capital so that I can hire a sales team, so that I can increase my marketing budget. All of those things may not necessarily come up if I just listen to you saying we want to grow from $20,000 to $40,000 a year. And it isn't even bad necessarily that you don't offer that information. But the narrative that is being told by you as the business owner, as the marketer, as the eternal optimist, where it overlaps with the P&L and where the P&L stays in more of a pragmatic standpoint, allows for a much more richer conversation and dialogue to take place. If we continue down and we looked at this example, this business has $6,000 in cost of goods sold. And this is where most business owners, I find, they live more on the numbers side and less on the percentage side. So this is one of the things that I wanted to talk about today. To me, the best way to approach a P&L is always through the percentage side, because percentages represent a slice of the pie, and that pie is fixed. It is 100%. Sales cost of goods, expenses as dollar amounts, there isn't necessarily a fixed amount to it. You could say, my cost of goods is $12,000. Sales is $20,000. And at first glance, that might sound very good. Oh, look, you've got gross revenue of $8,000. The thing is that, all right, I'm going to make my adjustment here. The thing is if I look at that as a percentage, like the P&L will tell me, I actually see the cost of goods is 60% of your sales. So for every dollar that you bring in revenue, it costs you 60 cents to make that product to be able to sell. Now I might think that that's really high, but what it's actually allowing me to do is, again, continue to ask more intelligent questions. 60% within your business doesn't really have context. But if I say, okay, tell me about the business that you're in, and you say, well, we sell apples. Well, there's probably an industry average for an effective cost of goods for businesses that sell apples. That information is readily available in Google, in talking with other industry experts and professionals in your field, talking with bankers who have financed these type of businesses, and suddenly you give context to that number. So in this example, you're doing $20,000 in sales, but your cost of goods are $12,000. That's 60% of your revenue. If the industry average is only 40%, well, we don't actually at this point need to go much farther in our P&L. We immediately get to start asking ourselves, why is it so much more expensive for us than it is for another business doing the exact same thing to be able to bring their product to market? So the P&L is sitting there, and it's not judging the fact that it's more expensive, but it's waving its arms back and forth saying, you know, this is something to explore. This is a question that needs to be asked and an answer that we need to find out. Say that you find out the industry average is 65%. Then you actually just got excited, even though in your mind you're like, wow, it cost me $12,000 to make $20,000 in sales, but you realize you're doing it 5% more effectively than anybody else in your industry on the average. So now that $12,000 line item has some orientation to it. And where it may have been a concern or an uncertainty for you actually is a great confidence factor. The other thing I like is, again, and actually before I go on, any questions about that? And that being looking at your sales, your cost of goods, items on your P&L as percentages versus just dollar amount expenses.
Nope, I think we're good.
Okay, great. So then, just continuing on, when we talk about percentages, again, that pie is fixed. It's at 100%. So now you start to actually have some orientation to the rest of your line items, and we'll get into talking about that. In this example, let's go back to 30%. Let's say our cost of goods represented 30% of our sales. So what we have left to work with to cover all of the operating expenses of our business is the other side, effectively 70% of our total sales. In this example, we're looking at $14,000, which again, that doesn't necessarily mean anything to us, especially if I start saying, oh, it's $500 for accounting, $300 for advertising and marketing. I want to know percentages. And the reason, again, is that percentages allow me to mark myself to my competitors. If I have $14,000 in gross revenue and my accounting, or let's look at my advertising and marketing budget, I've allocated $300, and I think that's too low. But then I actually do a bit of research and I realize my competitors are only allocating 1% of their gross revenue to marketing and advertising. While $300 might seem low to me, the reality is I'm actually putting twice as much in my marketing budget as other businesses in my industry. And that doesn't mean that we always want to necessarily mark ourselves to the industry, but it allows us to orient our expenses in a way that we are able to adjust them and know why we're adjusting them. Again, these things, if you look through them, I've just put in some basics to arrive at a net revenue number. But specifically, there's two line items that I want to explore, because in just about every organization, they represent some of the greatest expenses. And to me, expenses, every one of these line items is essentially a lever. And I like to refer to them as a lever because you have control over pulling that lever or not, how far you pull it, and that comes in the form of how much money you allocate towards each one of these. So the two that I've highlighted are labor and a rent, or possibly a mortgage, in this case the interest that you're paying on your mortgage. But let's talk about it as rent. Say you're leasing a space. Or even out of your own home. You have the ability to allocate a percentage of your home towards a rental expense. And that expense, while it saves you money on the personal side, you have to think about how your business is absorbing that expense and what percentage of your overall revenue that expense is taking up. Labor is by far, in just about every industry, the greatest expense that you have. I'm always hesitant to classify it as an expense because I'll be the first to say that labor, your staff, yourself, that's an investment always, but it does sit on the expense side of a profit and loss. Thing is, when I look at labor and I start to build out my allocation, thinking about it from a dollar amount sometimes is a bad way to go, because I start figuring out, well, if I hire these 3 people and it costs me $15 an hour, and I back into a number, a fixed number, and say that number is $8,000. I've essentially locked myself into that cost because I've already thought through what it's going to take for me to get that position. And that's not to say that that isn't a useful exercise, but I'd much rather approach it from the standpoint of percentages. And again, doing my research. If my industry standard for employment costs is 30%, then rather than lock myself into an $8,000 number, I actually say, you know what, 30% is going to be my cap. What can 30% afford me? Then I know that that actually is, that number becomes fixed as a result of me looking at a slice of the pie. So now it allows me to think creatively about that. If I say, look, I can't allocate more than 30% of my gross revenue towards labor versus saying I need to hire these 3 people and it's going to cost me $8,000. I now know I have $6,000 to work with. What can I do with that $6,000? It suddenly completely reframes how I'm going to approach my staffing issue. Aspects that may have seemed as important as others, I suddenly, because of this, realize those are secondary. They're not things that necessarily need to be addressed today. Or perhaps they're things that I might be able to get sourced in a more creative manner. The other thing that this helps with, especially organizations and businesses that are just starting out, is I can't tell you, the sooner that you can mark some percentage of your revenue to labor, the better off you are. I know firsthand, starting businesses, one of the things we do is we just cut ourselves out of the compensation equation. And the problem with that is it gets harder and harder to make compensating for skill sets part of your business structure. But if you said, okay, before I even sell $1, my gross revenue represents 100% of what I have to work with. And no matter if it's $100, $1,000, or $10,000, I'm allocating 30% of that gross revenue to labor. And when you put that in, you say, all right, we have $1,000, and basically that means that I've got $300 for labor. I can't do anything with that. That's okay. Put it in a savings account. Because the minute that you start marking your expenses as percentages of what you have to work with, then as your sales grow, all of those line items grow. They grow based on percentage. You don't have to suddenly say, man, okay, now I got to figure out how to absorb $1,000 a month in expenses for labor, because I never considered it as part of my cost allocation right out the gate. Any questions about that piece? All right.
No questions popped up, yeah.
Great. The other one, as I mentioned, is rent. Rent is oftentimes sort of seen as a necessity, but the reality is that looking at rent, there is a way to market to market. And, you know, I've done some work with restaurants, and restaurants typically, you see a space that you know is the perfect space. And too often you've already seen your business there before you actually bother to determine what the rent's going to cost, and more importantly, what is the percentage of that rent related to your sales. And I can tell you, for restaurant industry, the average allocation for rent should be between 5 and 10%. It's a little bit higher for bars than it is for traditional food establishments, but I've seen some restaurant businesses that are swallowing 15, 18% of their total sales towards rent. Now again, if they say, well, I'm only paying $1,800 a month, yeah, maybe that doesn't seem like a lot. But when you actually turn it into a percentage of your total sales and you realize, well, that's 18 cents of every dollar that I raise, you're putting yourself behind the 8 ball relative to your peers. And again, making it relevant to the narrative that you tell. Absolutely. You've got to tell the story that says, look, we're going to be in the best location. It's got great visibility, good parking, all of these things. It's going to be easy for customers to get in and out, vendors to deliver their products and get out of there. That is a story that has to be told by you. You have to see it. But don't overlook the story that the P&L is trying to tell you. Even if you ultimately choose to ignore it, that is absolutely your prerogative and the beauty of being the business owner. But if the P&L is saying, you know what, you're putting 18% of every dollar that you bring in the door toward your rent, and your industry colleagues are on average putting 5 to 8% in, don't be disappointed if you wonder why you're not making money compared to some of your other colleagues. And that's not to say that that is carte blanche. So it's always going to boil down to the nuances of every scenario. But in a general sense, which the P&L does operate in, doesn't care so much for the details. It tries to tell an unbiased black and white story typically. It's at least allowing you to orient yourself and orient your business expenses relative to your peers and relative to your target net revenue. So that's the last piece that I wanted to just go over with you in this example, is net revenue. Net revenue is also a fantastic place to start. There's tremendous information available to you on the percentage of net revenue relative to sales within your industry. It's amazing what you can find by just Googling things such as how much money, what is a target net profit margin for a restaurant? what is a target net profit margin for a grocery store? And you'll sift through articles, but you'll start to see common themes that say, on average, a restaurant should be making somewhere around 10% of its sales in revenue. Again, that doesn't mean anything from a dollar amount, but it absolutely means that 10 cents of every dollar that you raise should be going into your pocket, at least according to industry standards. So in this example, you can see net revenue, just based on the numbers that I put in, is 24% of sales. And you might say, wow, that's fantastic. But if you're in a particular line of business or an industry that has an average net revenue or an average net margin, and net margin is literally the dollars that you have left over divided by the sales. So when I say net revenue, I'm referring to the dollar amount. When I say net margin or net profit margin, I'm referring to the percentage. So in this example, this business has a net profit margin 24%, which they might say, man, we're doing great. But guess what? Industry colleagues, the average is 35%. So what does that mean for you? Well, it could mean that you're satisfied with 24%. It could mean that there's certain areas of your business that are costing you too much, like rent or marketing or accounting or labor. So suddenly all of those with their own percentage allocations start to have a greater meaning when you can determine, here's what our target net profit margin is, and then begin to work backwards from there. Any questions on looking at the P&L through a percentage lens, or understanding the relationship between line item expenses as percentages and your net profit margin as percentages?
And I know I muted some of you that were having some background noise, so if you'd rather ask a question than type it in, let me know and I can get you unmuted. Just raise your hand.
This is good. This is a pro group. They already know all this stuff.
Yeah.
I love it. So,
oh, we just got one here. In terms of growing a business or growing revenue, would you look at those expenses percentages in addition to ways to grow sales? Would you look at those expenses?
Okay, so I can see the question here. Let's see. In terms of growing a business or growing revenue, would you look at those expense percentages in addition to ways to grow sales? So the direct answer is yes. I mean, obviously, you're going to have a sales strategy. And if you think about it, there are certain line items in your P&L that directly relate to your sales strategy. Advertising and marketing, your labor, if you have a sales force, or if you have a customer support group, in some nonprofits, if you have a development team, or, so the answer is yes. If you think about it, you're always going to ask yourself, what is the purpose of increasing any of these line items? If you said, so let's just come up with an example. Let's say this business owner says, okay, look, our goal is to increase our sales from $20,000 to $30,000. And right now, we spend $500 a month on accounting. And we have $6,000 labor cost, of which, for example, $2,000 of that is dedicated to a sales team. Okay, great. So now we want to go up to 30%, or excuse me, we want to go up to $30,000, essentially increasing our sales by 50%. So the question to ask ourselves is, what expenses need to grow and at what percentages to achieve a 50% increase in sales? And oftentimes it's not a direct correlation. So if you said, well, you know, we're spending $500 a month on, $300 a month on advertising and marketing, if we increase that by 50%, that's an extra $150 a month. But is that going to be a direct correlation to sales? Probably not. Same thing if you said, okay, well, if we increase our sales staff from 2,000 to 3,000, is that going to give us a 20%, or excuse me, a 50% growth in sales? Not necessarily. So to your question, you absolutely are, anything that you want to accomplish. I want to grow sales. I want to hire a social media person. I want to start going to the Chamber of Commerce meetings so I can network. You as the business owner, you as the executive, you're going to formulate some sentence in a traditional narrative, and then you're going to say it. And too often, we jump right in and we go and we do it. Hey, I want to grow sales, so I'm going to hire a salesperson. I'm going to grow sales, so I'm going to start doing social media. But the P&L's over here waving its hand saying, well, let's look at it, because there's an appropriate way to do it. And we can simulate different scenarios. Because if you say, well, I'm going to hire this marketing person and it's going to be an extra $300, you've effectively increased your marketing expense in this example by 100%. And if I was looking at your business, I'd say, tell me about your strategy for increasing your marketing budget by 100%. And you said, well, it's because I want to grow my sales. And then I'd say, well, tell me what's the correlation between your marketing budget and your sales that you've accomplished up to this point. And that doesn't mean that you would necessarily have the answer. But again, the P&L is allowing for more intelligent, more kind of thought-provoking questions to begin to be asked, which, yes, that can sometimes open up a rabbit's hole, but every single time that we've gone down that hole, business owners come back feeling more confident in why they're making the decisions that they're making. And the P&L, by holding your expenses and sales in this fixed pie, creates that space, that playground space that I was referring to with my daughter, that allows you to stay in there and not go over without realizing that you've gone over. I'm seeing some more questions in here. So just to follow up on that one, in other words, work on those expense percentages as well as sales. Oh, yes. Okay, you got it. All right, let's see. Thomasina, can you put the cursor on the cell 35 so I can see the formula? Sure thing. And also, I'm happy to send this workbook again to any of you that want to tinker around with it. So cell C35 is, here's the formula up here. We're using the dollar amount for net revenue, and we're dividing it by our gross revenue, which in this example is net of cost of goods sold. If you were a business that was service-oriented and did not have cost of goods, obviously your gross revenue line item would be the same amount as your sales line item. Did that answer your question, Thomasina? All right, great. I'm getting the hang of this. Let's see. Here's another. Yeah. I learned from the best, Tracy. Thank you. Your orientation was very good. Let's see. Here's another question. From Allison, if there is an expense that you will have someday but don't have now, you said you should still incorporate that expense into your current total budget. But should you actually be setting those funds aside in the current year? Great question, and the less than great answer is it depends. And it really would depend. So in the example I gave, if Allison, if you and I were working together and you said, look, I really need to start allocating some of my sales to hiring a sales team. And I've done a bit of research, and industry says about 30% of sales go towards that. I don't think I'm in a position to do that. But I'd like to start at 10%. Then we would be able to, and by we I mean you and a banker. I mean any professional that understands that language can get in there and start helping you look at these different scenarios. and say you say, okay, that's going to be about $1,000 a month for me, and there are other things that I could do with that $1,000. So that would be the question then that I would say is, with that money, where else do you think it could go that would be of greater benefit? And that's not necessarily a black and white answer, but it does, again, I'm going to keep re-emphasizing the P&L is not the solution holder. The P&L is essentially allowing you to start asking more detailed questions of your business. And so to your point, that would allow you to begin to explore, okay, if it was $1,000, that's not enough to hire somebody today, but I don't know if I necessarily want to take that out of the business. But the question is, what do you do with that money instead? Is there a way that in lieu of hiring an employee, for example, you could bring in a contractor who could do half of that job, and you wouldn't have to be out of pocket the whole expense? But again, until you start organizing your P&L as a percentage, or rather orienting the universe of your P&L as percentages, it's very difficult to start thinking about, well, what does that do to your overall net profit margin target? Really what I'd say is that net profit margin, that's the most critical. If you say, look, in year one, my net profit is just a break even, it's zero, great. You now have the complete universe of sales to play with. If you say, no matter what, I want to start establishing at least a 3% net profit margin, well, now you know you only have 97% of whatever you bring in to work with. And the sooner you start determining what aspects are costs to your business, even if they're not necessarily costs that you have to incur today, it lets you start thinking about everything that's going to go and eat up that 97%. And then you have the ability to see, can I execute my business with the 97% I have so that I'm always retaining my target 3% profit margin? Did that answer your question, Allison? Great. Okay, I saw one other question. Can you speak to the difference between percentages that show efficiency and percentages that might also be too low or harming your business? Can it also tell that story? Absolutely. But again, it's orienting your business to relative to what? And that marker is, from my experience, the best marker is industry standards. So for example, if you say, okay, and I just keep using a restaurant example, if the industry standard for labor costs for a restaurant is 45%, and you're planning on operating your restaurant with a 25% labor margin, that may feel like a big expense, 1/4 of your total sales going to labor. But you're putting in almost half the amount of revenue in labor expense as your competitors are. And if you have a particular business model that allows you to function that way, fantastic. But if not, then you got to start asking yourself some difficult questions. What's the customer experience going to be like? How long are the wait times going to be? What happens if multiple customers come and sit down at the same time? You got to start playing these scenarios out. And again, that's where I will turn to the P&L and I'll pat it on the back and say, thanks for allowing me to ask these questions, because better to simulate them in a safe environment than go live and realize you made a mistake. And one more thing about that labor cost, again, because it's the biggest lever that you have to pull, you can get away with it when you do it at your own expense. As a business owner who says, you know what, I'm not going to get paid what I'm worth, or I'm not going to get paid at all, I would really caution businesses starting out to not go down that path. And that's somewhat related to Allison's question, because it's very difficult as you get going to start introducing new expenses. If you draw a line and say my target is a 3% profit margin, and you hold that line, but you've left out 3 or 4 critical expenses that you know you're going to need at some point in the growth of your business, and you suddenly have to introduce them, you could very well erode that 3% profit margin because you now have to introduce 3 line items that each need an allocation of 1% of your total sales. So suddenly you're at 97, then you introduce those 3 at 1% apiece, and now your profit margin is down to 0. Does that answer your question, Lauren? Well, feel free to put a note in there. I'm just going to wrap up here in the interest of time. A lot of this we've already talked about, but I just sometimes, if you're visual like me, it's easier to see it in addition to hearing it. But really what we spent the majority of the time on is just thinking about what are some questions to ask when you're reading your P&L. And questions such as, what is the standard cost of goods margin for my industry? What is a reasonable target for large expenses such as labor and rent for my industry? How much are other companies in my industry allocating to marketing as a percentage of sales, as a percentage of gross revenue? What is an acceptable net profit margin for my business and my industry? Or I'd add even for myself, what did I get into business for so that I don't have to work into perpetuity? What does my ideal staffing need to be? And again, that question is absolutely within context of percentage relative to your sales. And there's so much information that's available to you, but until you start utilizing your P&L and the story it's trying to tell, you're not even necessarily able to formulate the right questions. But I promise, go out, whatever business you're in, Google something to the equivalent of percentage of sales for rent for X business, or labor costs for X business. And again, you'll find a tremendous amount of information, and it will be varied. But the reality is you'll start to see some consistent themes. Your local business bankers, lenders, again, if they're lending to businesses within your industry, they're going to know these metrics because they're looking at these exact metrics when they're determining bankability for clients. Colleagues that are in your industry, people who've been around for a while that you can trust, who are serving as a mentor, ask them straight up, what percentage of your sales goes towards your labor costs? I'm trying to figure out how to allocate my budget appropriately. And then, of course, you got Tracy. You got the EDC business coaches, the other resources in there. These are real people who've seen hundreds of thousands of business plans and hundreds of thousands of financial statements. And if they're not versed in a particular industry, I'm pretty confident they can put you in front of somebody who is. And then lastly, there are outside consultants such as myself who are numbers geeks, who love this kind of stuff regardless of industry, who can get in there, talk to the P&L and understand what it's trying to say. And lastly, just to wrap it up, why understanding the P&L is important. In business, speaking 2 languages is very good. I grew up in a household, my dad's fluent in speaking Spanish. He didn't teach it to me and my brothers and my sister, and we give him grief to this day about it. In business, if you can understand even a little bit of the language that a P&L is speaking, you have the opportunity to really open up a world of opportunities for yourself. I mentioned the ability to approach bankers, accountants, and other numbers speakers. When you understand the P&L, when you can formulate some of these critical questions, you're sitting down with them as professional partners and not as somebody who necessarily is needing to be told what to do, which isn't a great relationship. The next level questions, things that we explored, they start to unlock opportunities. And one example, and it is one, but this is a really good example that I wanted to share with you. I was working with a restaurant client. We know banks typically shy away from restaurants in any sort of financing due to the level of risk. But the ability to look at the financials, the ability to understand where funding was needed, allowed us to carve up the ask in a particular way. And what I mean by that is a restaurant's trying to get off the ground is looking for $200,000. They're going to need some for build out, some for equipment financing, and some for working capital. Banks aren't necessarily interested in lending on the build out. There's no collateral for that. But equipment financing is absolutely something banks do, especially if the equipment is new. There's a real asset there. Working capital lines of credit, those are absolutely things that banks will look at lending. So by carving it up and saying, all right, actually that $200,000 ask, we're not going to just sit down in front of a bank and say, I need $200,000. We're going to say, you know what, we need about $30,000 for equipment financing. We need about $50,000 for working capital. Now the conversation that I'm going to have with the banker is going to be entirely different. And the questions that they're going to ask me are going to be able to get to that next level. And then lastly, just, again, understanding that second language, in addition to the story that you tell, every one of those line items is a lever. And that's the term I'll use over and over, because you have control over how much you pull them, if you pull them. And by looking at each one within a confined universe, which is 100%, the full pie, you can determine whether you're pulling something too hard, not enough, or possibly you need to make sure that that lever is even inserted into your business. Thanks, Tracy, and everybody else for the time. I appreciate going over a couple extra minutes. I'm going to hand it back over to you, just obviously being mindful of everybody's time. But I really appreciate the opportunity to spend an hour with you today.
Yes, thank you so much. This is wonderful. And I don't know if you have another slide on there that shows your contact information. If not, I'll send that out to everybody in the email, so that if you did have a question later today when you're thinking about it, or down the road, feel free to reach out to Erin, or somebody at the Women's Business Center if you have questions about these, and get those answered. But thank you again, Erin, for your time, and thank you everybody for spending your time with us today. I will send out all this information via email a little later today. Have a wonderful rest of your day. Thanks again, Erin.
Bye.